we have to be acutely aware that the geopolitical conflict continues unabated and policy normalization globally is far from complete. Headline inflation across countries is on a downward trajectory, but is still high and above the targets. Labor markets in many countries are tight and demand is rotating back from goods to services. Hence, central banks across the world remain on high alert and watchful of the evolving conditions, even though many of them have tempered their rate hikes or even taken a pause. Financial stability concerns persist in advanced economies, although they appear to have been contained due to resolute actions. Retrenchment in trade, technology, capital flows caused by geopolitical fault lines and economic fragmentation further complicate the situation. In these challenging times, the Reserve Bank of India has continued to focus on preserving price and financial stability, while ensuring adequate flow of financial resources to all productive sectors of the economy. As a result, domestic macroeconomic fundamentals are strengthening. Economic activity is exhibiting resilience. Inflation has moderated. The current account deficit has narrowed, and foreign exchange reserves are comfortable. Fiscal consolidation is also ongoing. The Indian banking system remains stable and resilient. Credit growth is robust, and domestic financial markets have evolved in an orderly manner. Let me now turn to the decisions and deliberations of the Monetary Policy Committee. As many of you would be aware, the Monetary Policy Committee met on 6th, 7th and 8th June, and based on an assessment of the macroeconomic situation and outlook, the MPC decided unanimously to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility and the bank rates, they stand at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. Let me now explain the MPC's rationale for these decisions on both policy rate as well as the stance. The MPC recognized that the pace of global economic activity is expected to decelerate in 2023. That's in the current year. And this is mainly because it is getting dragged down by elevated inflation, tight financial conditions, and geopolitical tensions, which are still continuing. The pace of monetary tightening has slowed in recent months, but uncertainty remains on its future trajectory as inflation continues to rule above targets across the world. And in the last few days, you would have noticed that 2 major central banks have, after adopting a pause for several months, they have gone for increasing the policy rates. So therefore, what I am saying is that the monetary policy, the pace of monetary policy has slowed, tightening of monetary policy has slowed down, but uncertainty remains on the future trajectory as inflation continues to roll above targets across the world. In India, consumer price inflation eased during March-April 2023 and moved into tolerance band, declining from 6.7% last year, that is 22-23. Headline inflation, however, is still above the target as per the latest data and is expected to remain so according to our projections for 23-24. So when I say headline inflation is still above the target, I am referring to headline inflation as per our assessment will remain above 4% throughout 23-24. Therefore, close and continued vigil on the evolving inflation outlook is absolutely necessary, especially as the monsoon outlook and the impact of El Nino remain uncertain. Real GDP growth in 2022-23, on the other hand, turned out to be stronger than anticipated and is holding up well. The policy repo rate has been increased by 250 basis points since May last year and is still working its way through the system. Its fuller effects will be seen in the coming months. Against this backdrop, the MPC decided to keep the policy repo rate unchanged at 6.5%. The MPC will continue to remain vigilant on the evolving situation and the growth outlook. It will take further monetary policy actions promptly and appropriately as required to keep inflation expectations firmly anchored and bring down inflation to the target. With the policy repo rate at 6.5% and full-year projected inflation for 23-24 at just a little above 5%, the real policy rate continues to be positive. The average system liquidity, however, is still in surplus mode and could increase as rupees 2,000 banknotes get deposited in the banks. Headline inflation, as noted before, is easing but rules above the target, warranting close monitoring of the evolving price dynamics. Taking all these factors into account, the Monetary Policy Committee decided to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. I would now proceed to provide our assessment of growth and inflation. Let me first focus on growth. India's real gross domestic product, that is real GDP, recorded a growth of 7.2% in 2022-23, stronger than the earlier estimate of 7%. It has surpassed its pre-pandemic level by 10.1%. Real GDP growth in the fourth quarter of 22-23 accelerated to 6.1% year-on-year from 4.5% in the third quarter of last year, aided by fixed investment and higher net exports. On the supply side, real gross value added, that is GVA, accelerated from 4.7% in Q3 to 6.5% in Q4, driven by rebound in manufacturing activity, which moved into expansion territory after 2 quarters of contraction. Turning to 23-24, domestic demand conditions remain supportive of growth on the back of improving household consumption and investment activity. Urban demand remains resilient with indicators such as passenger vehicle sales, domestic air passenger traffic, and credit cards outstanding posting double-digit expansion on year-on-year basis in the month of April. Rural demand is also on a revival path. Motorcycle and three-wheeler sales increased at a robust pace year-on-year in April, while tractor sales remained subdued. Growth in steel consumption and cement output and production and imports of capital goods suggest continued buoyancy in investment activity. On the back of double-digit growth of...
All right. In fact, the RBI Monetary Policy Committee decides to keep the repo rate unchanged at 6.5%. Let's go across to Samir, my colleague who is joining us on the broadcast for more details. Samir, we have the RBI's Monetary Policy Committee deciding to keep the repo rate unchanged at 6.5%.
Yes, definitely taking the current economic scenario, the RBI, the viewpoint that the economic situation in the country is quite strong and it is quite resilient. And So looking at the same, the RBI, the governor has decided to keep the repo rate unchanged, and now it is at the same 6.5%. Even the SGF rate also remains unchanged, and it is at 6.25%. But the RBI governor has clearly indicated that the focus is going to be on the withdrawal of accommodation. It has also been forecasted, it has also been estimated that the inflation will remain above 4.5% in the financial year 23-24. So the inflation is also in a controlled position that RBI estimates, and seeking that the economy, the way it is heading, and it is quite stable. The RBI has kept the repo rate unchanged, and it is at 6.5%. RBI understands that in the next quarter, inflation is likely to soften further, and then it might take a call to reduce the repo rate. But as of now, it has been kept unchanged at 6.5%.
Sameer, thanks very much for joining us with all those details. So the RBI keeps the repo rate unchanged at 6.5%. In fact, the RBI governor says that the Indian economy and the financial sector stand strong and resilient amidst unprecedented global headwinds.